we've all been reading the headlines. Unfortunately, major retailers are shutting down stores across the country, and some companies are going bankrupt and will be gone forever. So what's going on, and more importantly, what does it mean to you and me? What should we be doing? According to a CBS report recently, the headline is "Store closures are surging this year. Here are the retailers shuttering the most locations." So I'm going to show the chart that shows the stores that are closing. But first I want to share with you some quotes from this article. Retailers have announced plans to close almost 3,200 locations in 2024, and that's a 24% increase from a year ago. And CBS goes on to say some are victims of poor management, but others are struggling with changing consumer behavior. And unfortunately, some of this changing consumer behavior is we've all got less money, right? Prices have gone up. Unfortunately, wages haven't kept up with inflation. And so we're all cutting back. And the consumer represents 70% of the US economy. So if we cut back, guess what happens, right? When the consumer catches a cold, the whole country sneezes. CBS goes on to say a lot of this year's closures are related to bankruptcies of chains that have been in trouble for a while, like Rite Aid and Rue 21. Neil Saunders, the managing director of Global Data, is the one that shared this site. He goes on to say we're also seeing several retailers like Family Dollar take action to weed out underperforming stores. Now the question is, why are they underperforming? And we'll get there in a minute. And last thing before I share the chart, although consumer spending has remained solid this year, there are pockets of softness, and retailers want to ensure they're in good financial shape to weather any challenges. And that means optimizing store portfolios. But you know what? I think there's more going on than just that. These are the store closures here. These are big numbers. Look at Family Dollar. It's closing 621 stores. That we mentioned Rue 21, 543 stores. The next one, 91 cent stores. 7 is closing 371. CVS Health is closing 315 stores. 7-Eleven, 272 stores. Rite Aid is closing 165 stores. So one of the things that worries me is when these dollar stores, which really now should be called $5 stores, when these dollar stores start closing down, because these are the most affordable outlets for most people. And this is where low income to lower middle class America goes to shop. And so what that tells me is the consumer's under a lot of stress. The fact that Family Dollar and the 99 cents only stores, they worked hard to open those stores. They don't, it takes effort finding the real estate, having the store built out, opening it, staffing it. They worked hard to get into those locations. And what's changed over the last 2, 3, 4 years that's driving this? What do we do about it? So I'm going to get to what we do about it, but first I want to share with you another article. This is by the US Sun. I think the headline's a little sensational. It says, "Retail Apocalypse." Is it a retail apocalypse? I don't know. Let's keep going and find out. The sub-headline is, "Shuttered stores, we're doomed," cries customer as convenience store chains known for frozen drinks sets to close 270 locations. Now, I don't know if we're doomed or not, but let's go on and read. And there's 9,400 7-Eleven stores in the United States in 38 states and territories. And they're closing that 270. They're also planning on opening about the same number. Okay, so I want you to know that they haven't disclosed what locations are being shuttered, but they did say that in 2023, instead of 272 locations, they shut down 184. And so that's, an increase of 50% more stores. I did read somewhere that 7-Eleven is also opening about an equal number, so that doesn't worry me that much. Now, 7-Eleven is a good operator. My father used to work in a convenience store, not a 7-Eleven, but something like that. And it's a tough business, and 7-Eleven does it as well as anybody. Okay. But it's not just stores like dollar stores and 7-Eleven. We're now seeing Home Depot, we're seeing Lowe's shut down stores. And in fact, Home Depot is reporting that sales are beginning to weaken. This is according to CNBC. Home Depot expects sales to weaken as consumers grow more cautious. And that's what I think we all need to think about is as the consumer, as we have less and less money to spend because our wages aren't keeping up with inflation, because costs keep going up, unfortunately because layoffs are taking place. As we all start spending less, what does that mean for the likelihood or hopefully the unlikelihood of a recession? I think you'd have to be foolish to say that the likelihood of a recession today is less than it was 6 months ago or a year ago. I think the likelihood of a recession is higher now than it was a year ago. Now, interestingly, there's surveys taken of mutual fund managers that are professionally looking at companies, looking at their prospects and investing in some companies, right? These are the people that are managing the mutual funds that many of us have in our investment accounts. And those money managers are saying there's only a little bit higher than a 10% likelihood of a recession over the next 12 months. It's 11% is the exact number. Now, I don't know about you, but I would anecdotally, just from what I'm seeing, place a higher likelihood on that. And in fact, Jamie Dimon, who's the CEO, the top guy at JP Morgan Chase, his odds of a recession, he says the same thing I am, that people are dramatically underappreciating how likely a recession might be. Jamie's not saying there's going to be a recession, but he places the likelihood north of 30%. And that's kind of where I'm at. I think it's a 30 to 40% likelihood. And there's a couple reasons for that. One, the consumer is clearly slowing. Two, time is not on the side of the Federal Reserve. We've had rates increase for a while now. What in an ideal situation, you raise rates, things slow down, but you come in for a soft landing. You don't crash down. That's what Jerome Powell, who's the chair of the Federal Open Markets Committee, that's what he's hoping to achieve, is a soft landing so we can avoid a recession. Remember, the Federal Reserve has a dual mandate, not just to keep inflation under control, but to keep the country at full employment. And I think it's good that they have that dual mandate. And we're all hearing whispers as I record this that pretty soon the Fed is going to start lowering rates. And the reason I think they're doing that is because we're starting to see unemployment go up. And the risk of a recession, as I said earlier, time is not on our side. The risk of a recession, I think, goes up the longer we have to have these high interest rates. So what should you and I be doing with this information? Unfortunately, as easy as it is to identify a recession in hindsight, it's super hard to predict it going forward. And success in the market, this is a good thing. Success in the market is about time in the market, as opposed to trying to time the market. So over time, if you look at a stock chart, it goes up and to the right over time, over a decade, 20 years, 30 years. And the good news is if you have time on your side, if you have money that you can invest for an investment cycle, which is 7, 10, 15, 20 years, the odds are dramatically in our favor that the market's going to go up and to the right. But when we try to time the market, and it's super tempting to do it because in hindsight, things are just so obvious. But looking forward, it's super hard to predict these things. So what do I think we should do? I think we should have a long-term allocation that we stick with in good times and bad. What percent of your portfolios in stocks? What percent of your portfolios in bonds? And if you're not there, boy, it's a heck of a lot easier if you need to sell some stocks, if you have overexposure to stock, if a 20, 30, 40% correction would force you to have angst, not just worrying, but staying up at night factor. If you have too much stocks, it's a lot easier to get your allocation right when the stock market is at or near all-time highs than it is to make that change after the stock market has made a 20, 30, 40% correction. So make sure your asset allocation is correct, and try to get comfortable with that volatility, the ups and downs of the stock market. As I record this just recently, we had a big sell-off on a Monday. It was the Japanese unwinding trend. But you know what? Just 8 days later, the market had its best week in the entirety of this year. So it's hard to predict these things. So buckle up, get your asset allocation right, and be able to weather the storm. Clearly, this is not good news that I'm sharing with you here, but I'm hoping this is good news for you. This is the next video. The YouTube algorithm says you'll enjoy this video. Click on it, watch it, and let me know if YouTube was right. Thanks for watching this one.